Hello, everybody, and welcome back to the Open Interest YouTube channel. I'm Mike Khouw. Another rocky day for the markets as investors continue to digest the implications of a more hawkish Fed. We discussed Fed Governor Lael Brainard's comments yesterday. Today, the focus was on the anticipated pace of reducing the Fed's balance sheet, a number some are placing at about $95 billion per month beginning in May, based on the Fed minutes. Now, just to put everybody in perspective here, remember that they were adding to the Fed's balance sheet at about $100 billion per month, later slowed that pace to about $85 billion per month. Several of the large trades we highlighted yesterday were immensely profitable today. As ARK fell over 4.6%, the large put spread we highlighted is up roughly $1 million. EZU, the Euro Monetary Union ETF, dropped 2%. And of course, that bearish put spread also profited immensely. And we also saw a large bearish bet in HYG. That fell nearly 80 basis points. That may not seem like a lot, but that's actually a very large single-day move for a fixed income fund. So I have encouraged viewers to send me some questions and comments. So I think it's only fair at this point if I actually respond to a few of those. So let's take a couple questions. Let's see here. The first question comes from Mike T. Barber, and he's referring now, I think, to the May 360, 320 put spread in the triple Qs that Carter and I discussed on Options Action last Friday. And he says, do I sell this now? I never make money on these options because it is all timing. I am green, but chances are low we are below 360 in the middle of June. Okay. So a couple things about that. First of all, you're right. Timing bearish bets is difficult. The market in general rises over time. So bearish bets are contrarian, and naturally it's going to be harder to be profitable. But whether or not you take profits, and I was taking a look at the average prices on Monday, which would have been the first trading day after we made that recommendation Friday evening, when you could have put that on. And indeed, this was quite profitable today. The question about whether or not you close it depends really on whether or not you have the put spread on as a hedge against your portfolio. If you have a lot of tech names in your portfolio and this is a hedge, then even though it's profitable, you wouldn't generally take this off, because in the case of hedges, we essentially use it as insurance. There's a chance that the market recovers. You don't need it, but basically it's to provide some insurance if between now and May expiration it continues to fall. But I'd also point something else out, and that is that you don't necessarily, if you were just making a directional bet, or if you put it on as a hedge and you're not sure whether we might get some kind of a bounce, you don't just need to close it. There are other things you could do. We're now seeing that 360 put is actually well in the money. You could always just roll that down, and that way you could take some of the money off the table, but maintain some additional downside protection or an additional downside bet, if that's the way you're playing this, down to 320. So that's another way to play it. Okay, so why don't we go ahead and take another question. At Sanford Tommy asks, would like to know if you think he, referring to Peter Boockvar, is right regarding a recession. So what we're talking about here, when we talk about a recession, what we're talking about is negative economic growth. So we can look at that as GDP. And for those that didn't see it, Peter Boockvar is a well-known strategist who appeared this morning and was talking to Becky Quick in the early part of the day and some of the first programming on CNBC. So here's the thing. Unfortunately, I agree with Peter Boockvar, which was actually the reason why I shared the link to that clip to begin with. We have had essentially a tailwind of declining rates, of easy monetary policy, helping to propel a recovery in the economy. Of course, we also had just sort of a natural snapback, I think, that would occur. I think we now are facing headwinds on several fronts. And I am sort of hard-pressed to figure out how we can navigate rising rates, some other signs of economic slowing, rising concern amongst investors and consumer sentiment, continuing pressure in the supply chain. All of these things, when you put them together, any one of them, we probably have a resilient enough economy. And then you add in geopolitical tensions and concerns. That's a lot, I think, for any economy to absorb. And we've had a very prolonged period, absent, of course, the pandemic drawdown, of prolonged economic growth. We live in economic cycles. It's hard for me to see how we don't have some setbacks going forward in the near future. I wish it weren't so. Okay, so let's take a look at another question. Keith Westfall asks, if I would have bought a 1 month out straddle when Elon started talking about Twitter, how would that have worked out? Okay, in a word, very, very well. Twitter obviously took off when it was announced that he had taken a very large stake, over 9%. He's actually now Twitter's largest shareholder. And what I did was I just went back to the second week of March, I think March 11th, Friday. I was taking a look at the at-the-money straddle that expired just a little over a month from that time, which is the one that's going to expire a week from this coming Friday. That straddle was about $4.50 when I was looking at it. It was the at-the-money straddle, 35 strike. Both the call and the put, I think, closed that Friday close to 2.25 a piece. So we're talking about $4.50. The stock was over 50 today. The put's worthless, but that wouldn't have mattered very much because that call is way in the money. So you would have more than tripled your money, almost quadrupled it, in fact. And that's an important thing to remember about long straddles. Usually when we talk about using options to make directional bets, we would prefer that you pick a direction. And that's because it's not only that the stock needs to move in that chosen direction, it needs to actually move a decent amount before you see profits, and options decay over time. So it's not just that you need it to move, you need it to move within the time horizon that you've chosen. Alternatively, though, if the moves are really exceptional, and I think we can safely describe the move in Twitter as exceptional, then it almost doesn't matter whether you bet that it's going to go up or down, because it's going to move enough that the profits from the profitable side will more than make up for the losses on the other side. Okay, the next question we have. Matt Hames asks, I'm curious about any recent green energy or EV stock option activity. Okay, so well, first of all, in the EV space, there's always a ton of options activity. The most active by far, in fact, the most active single stock option, generally speaking, is Tesla. And Tesla has done exceptionally well. We've seen a lot of bullish activity over a lengthy period of time. In fact, we saw, even as exceptional as the volume typically is in Tesla, we even saw above average unusual volume after the Twitter announcement. I don't know whether that's just follow-on activity, for anything that Elon Musk was touching, whether it was follow-on activity following news of the stock split, which did propel a significant amount of options activity. But we have seen a lot in there. RIVN, Lucid, not nearly as much as Tesla, but these also are very active options. We're talking about 60, 70, 80,000 contracts a day plus, very common in those names. But the volume hasn't been notably unusual recently. We have, of course, seen a lot of activity in the carbon energy space that's been unusual, and that's because of the volatility we've been seeing in that area. In the green space, what I would point you to where we did see unusual activity was in CCJ. That's Cameco. So the uranium space generally has seen elevated options volumes, and this one in particular did today. This may, some people will think of this as green energy, others won't. A lot of people who are trying to look at alternatives to carbon-based fuels have been pointing out that it's probably going to need to include, our energy solutions are probably going to need to re-examine the use of nuclear. A lot of the other green energy solutions, whether we're talking about wind, whether we're talking about solar, they have a lot of hair on them. They either have a very big footprint, they have very high material use, the energy sources can actually be sporadic. We saw that as an issue in Germany. Germany invested heavily in solar, heavily in wind, and yet their renewables generation actually fell year on year simply because it wasn't as windy and it wasn't as sunny. And And those kinds of problems need to be mitigated with something that can be a little bit more consistent. So I think some people are looking at nuclear potentially as a green source of energy, and we have seen a lot of activity in CCJ and in URA, which is the uranium ETF. Okay, so that's all I've got for you guys today. If you have a comment or a question, please leave it for me below, or you can always send me a tweet at Michael_Khouw. Appreciate your time. Thanks for watching. If you liked the content, please consider subscribing to the Open Interest YouTube channel. That's youtube.com/open interest. And of course, you can also follow or tweet me at Michael_Khouw, or go to our website, www.openinterest.pro. Thanks for watching.